Many investors have a lot to be thankful for this year as we approach the Thanksgiving holiday. This is led by equity market gains, including both large company and small company indices closing near all-time highs as of late November. 2024 has seen positive equity gains in 9 of the 11 months so far, and the widely followed S&P 500 index was up 25.5% year to date as of November 25th. And November to date gains have not disappointed either, with the large company S&P 500 up 4.9% for the month through November 25th, and even better was a November surge in the small company Russell 2000 index, which increased 11.2% for the month, its best monthly gain in more than 2 years. Our November message is all about the 2024 election because equity markets have reacted positively to Donald Trump's relatively convincing win as investors focus on a pro-growth economic narrative driven by expectations for reduced regulation, lower taxes, and smaller government. By also winning control of the Senate and the House of Representatives, the Republicans will be better positioned to support President-elect Trump's agenda. So how rational is the current rally? Well, if the pro-growth policies of the new administration take hold, recent equity market gains are rational in our view and can build on recent data that has already exceeded expectations. This includes a U.S. economy that grew 2.8% in the third quarter of 2024 and 3% in the second quarter, and S&P 500 Q3 year-over-year earnings growth that is up about 6% and better than was expected just 2 months ago. Even before the election, expected 2025 earnings growth was positive, and pro-growth policies from the incoming administration could add to earnings estimates. Since the middle of 2024, equity market gains in the U.S. have broadened out to include more sectors and more companies. In our view, this is a healthy development and can continue. Cyclical sectors, those where revenue and profits can more directly benefit from economic growth, can continue to lead. And this includes sectors like financials, industrials, materials, and energy. And we also want to maintain technology exposure. There are concerns, however, as market valuations are elevated and market pullbacks are inevitable. Pro-growth policies added to strong current trends could lead to renewed inflation pressures and rising interest rates. Already, since the Federal Reserve began lowering its overnight interest rate targets in mid-September, market-traded interest rates, like the yield on the U.S. 10-year Treasury bond, have actually moved higher. And also, we don't know the potential economic or market impact that could be caused by global tariffs and deportations. These policies, while supported by many, will also be met with stiff opposition and can cause market volatility. We address these risks using our familiar playbook of diversification and rebalancing. We're long-term investors and recommend building diversified investment portfolios incorporating high-quality assets that create balance during market cycles. 2024 has been a good year for many investors, and rebalancing makes sense in this environment. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.